Okay, let's just think about this for a second. We've got bombs falling in the Middle East, geopolitical risk is just soaring, and oil is blasting past $100 a barrel. Now, every single textbook, every market analyst would tell you that in this scenario, the world's oldest safe haven, gold, should be absolutely rocketing to new highs. But it's doing the exact opposite. It's plummeting. I mean, we're talking down nearly 20% and one of the worst collapses we've seen since 1983. So what on earth is going on here?
And this quote right here, it just perfectly frames the puzzle we're trying to solve. Look, gold isn't failing to do its job. What we're actually seeing is that the simple rule book most people use for gold, it's been thrown out the window. We're about to uncover a deeper, more powerful set of rules that really drive markets in a crisis, rules most people have never even seen before.
And this is the whole game right here. We have to shift how we're looking at this. We shouldn't be asking, hey, why aren't people buying gold for safety? No. The real question, the one we need to answer, is what powerful force is causing people to actively sell gold at the very moment it's supposed to be their biggest protector? Let's break it down.
All right, let's start with the most obvious reason you'll hear. And it's definitely a piece of the story, don't get me wrong, but it's only one piece of a much larger, much more mechanical puzzle that's at play.
This right here, this is the single most important number in finance right now. It's not the price of gold, it's not the price of oil, it's the yield you can get on a 10-year U.S. Treasury bond. And I'm telling you, that one number explains more about why gold is falling during a war than any headline you're going to read. So this all boils down to a pretty simple idea called opportunity cost. Think about it. Gold, for all its history, is what we call a non-yielding asset. It just sits there. It doesn't pay you anything to own it. But right now, today, you can get a guaranteed, basically risk-free return of 4.25% from the US government. So if you're a big money manager, you're faced with a choice. Hold the shining rock that pays you zero, or hold the safe bond that pays you a handsome return. It's not really a tough decision, is it? It becomes genuinely painful to own the thing that pays you nothing.
And here is the great irony in all of this. The war itself is actually helping push gold down. It's crazy, right? The conflict pushed oil prices way up, and that sparked huge fears about inflation. And what does that do? It forces the Federal Reserve to come out and say, hey, we're going to have to keep interest rates higher for longer to fight this. And that signal? That's what pushed bond yields up to that magic 4.25% number, which in turn makes gold look even less attractive. So the war didn't save gold. It actually helped create the perfect storm for its fall.
But look, high interest rates, they explain why gold might drift lower. A gradual shift, they do not explain the violence of this crash. To get that, you have to understand the real motive here. The force that turns a simple correction into an all-out collapse is a desperate, system-wide need for one thing: cold, hard cash.
You know, in the first terrifying moments of a real crisis, the driving instinct isn't some abstract search for safety. It's a very practical, very urgent need for liquidity, the ability to get cash right now. As the old trader saying goes, in a panic, you don't sell what you want to sell, you sell what you can sell. And guess what? Gold is one of the easiest, most liquid assets on the entire planet to sell in a pinch.
So here's how it works, mechanically. The war creates chaos, right? So stocks start to fall hard. Well, this triggers something called margin calls for traders who are using borrowed money. All of a sudden, their brokers are on the phone demanding cash, and they need it immediately. So what do they sell to raise that cash? They don't sell their garbage stocks. They sell the thing they can get rid of the fastest for the best price. And for many of them, that's gold. It's just a chain reaction.
So we've got high interest rates pulling investors away, and a desperate dash for cash forcing traders to sell. But even that isn't the whole story. To really understand the sheer scale of the selling pressure, we have to pull back the curtain and look at two powerful, totally unseen forces that were dumping gold for reasons that have nothing to do with fear or greed.
This is just fascinating. Go back to 1983. Gold crashed then too. Why? Because Gulf states like Saudi Arabia were forced to sell their gold reserves when their oil revenues completely collapsed. Okay, now fast forward to today. The Strait of Hormuz is closed, oil's at $100, but these countries can't physically ship a lot of it. Their revenue is blocked. So what do? They reach for the exact same playbook from 40 years ago. They start selling their gold to raise US dollars to fund their governments. It's history repeating itself.
And the second hidden player? It's not even human. It's the machines.
You see, hedge fund algorithms don't read the news. They don't care about geopolitics. They are programmed to just execute commands based on very specific financial triggers. And recently, two of their biggest sell gold now triggers were hit at the exact same time. The US dollar index, the DXY, rose above 100, and that 10-year Treasury yield we talked about went above 4%. That's it. Billions in sell orders were unleashed automatically, adding this incredible downward pressure. The machines were just following orders.
And all of this selling created this vicious feedback loop, especially for everyday investors who use these things called leveraged ETFs. These are products designed to give you, say, double or triple the daily move in gold. But there's a catch. Because of how they're built, when gold dips even a little, the fund's own mechanics automatically force them to sell gold to rebalance their books. Well, that selling pushes the price even lower, which then triggers even more forced selling from other funds. It's a downward spiral, and it's driven entirely by product mechanics, not by how anyone feels about the war.
Okay, so how do we possibly make sense of all this? How can gold be this ultimate safe haven and also be crashing during a war? Well, the resolution to this entire paradox, the key that unlocks it all, is understanding that we're not talking about one gold market. We're actually talking about two completely different ones.
This right here, this is the single most important thing to get. All that selling pressure we've just been talking about, the margin calls, the algorithms, the ETF unwinds, every bit of it is happening in what we call the paper market. The market for actual physical bars and coins is telling a totally different story.
So you've got the paper market on one side. That's all the futures contracts, the ETFs. It's driven by huge amounts of leverage and computer algorithms. It reacts in seconds, and that's the market that crashed. But then you have the physical market. This is the world of actual gold bars and coins. It's driven by long-term demand from big players like central banks and institutions. It moves slowly over months and years. And believe me, that demand is still incredibly strong.
And we have plenty of evidence to back this up. Central banks around the world, they're continuing to buy physical gold at a historic pace. Demand from long-term buyers, jewelers, it's all holding steady. In fact, if you look at major banks like JP Morgan and Deutsche Bank, they're still maintaining their year-end price targets of over $6,000 an ounce. They see what's happening now as a short-term paper event, not some big change in the fundamental physical story for gold.
So, if the daily price of gold is really just noise coming from this chaotic paper market, what should you actually be watching to figure out what happens next? It's not about guessing the price. It's about understanding the mechanics that are driving the machines.
These are the two numbers that really matter. These are the triggers for all that mechanical selling we've talked about. First, the US dollar index, or DXY. Just think of it as a measure of the dollar's strength. As long as it's above 100, it's a headwind for gold. Second, that 10-year Treasury yield. When it's above 4%, the opportunity cost of holding gold is just too high for big money. When you see these numbers start to reverse, like the DXY dropping back below 97 or that yield falling below 3.5%, that's your signal. That's the sign that the mechanical pressure is finally letting up.
So I guess the crucial point to leave you with is this. What we're witnessing here might not be gold failing its oldest test as a safe haven at all. Instead, what if it's one of the largest transfers of ownership we have ever seen? A massive shift from the fast money, highly leveraged hands of paper traders into the strong, patient hands of long-term physical holders. And if that's the case, well, that's a very different story indeed.